Let's focus in on the economic survey, lots hinging on that, and we've got Supriya Srine joining in live from New Delhi to take that discussion forward, and all eyes on what the growth projections are going to be this time around.
Thank you very much, Avan, for that. All eyes on the economic survey, which is really a statement. And in the view of the Finance Ministry, what the economic landscape will be, what will be the prospects of Indian economy, what are the headwinds and the tailwinds that will continue to gather pace. But joining me in the studios right here, Swaminathan Iyer, our consulting editor, and Maithili Bhusulmath, our consulting editor as well. Thank you very much, each one of you, for being with us. We'll, of course, be joined by an eminent panel, a panel that you cannot afford to miss. Arvind Subramanian's second economic survey. What are your expectations? Speculation within North Block is this is going to be a revolutionary survey of sorts. Swami.
The economic survey is a document where the chief economic advisor is allowed to depart from the government and give his ideas, radical ideas, for the future. Future doesn't necessarily mean 2 years. It may be for finance ministers who are not yet born. But the whole idea is that you can put forward a revolutionary new thing, which is not necessarily part of the government. So that's an important part of the economic survey in terms of a think-tanking attitude. Over and above that, then there will be an enormous amount of long, boring stuff on how the economy has performed over the last year. There will be some prognostications for what's going to come. Last economic survey, they had predicted that for this year, we're going to have GDP growth of 8 to 8.5%. That has not happened. I suppose the economic survey will attempt to put a good face on that particular thing. There have been disappointments, but even the 7.6% that we are seeing from the CSO as likely, there are a lot of other people at the ground level who say, you know, it doesn't feel like 7.6. And if you just see Suresh Prabhu's railway budget of yesterday, that the earnings are down 8%. If earnings are down 8%, does that sound like an economy which is the fastest growing economy in the world? People are raising all these questions. There can be explanations. Right. You can say if telecom goes up or Flipkart goes up, then maybe the railways don't go up. But nevertheless, the mood is somber. And I think the international winds that are blowing in are extremely chilly. So there are problems domestically and there are problems externally. Right. And I think the economic survey will have to take note of those.
So, Maithili, what is your take on this entire bit? 8 to 8.5% growth was being projected last year. Sources seem to suggest that growth levels could be tapered down 7.5 to 7.75%. A, does that leave you impressed? But given the global headwinds that Swami mentioned, and B, you can make lengthy projections, you can be very ambitious in the survey, but the ground reality is that not much has changed. Factory orders are not looking up, and like Swami said, railways earnings are down by about 8%. So that's an indicator. Railway budget came 3 days before the union budget is. So that's an indicator as well. What's your take as far as the survey is concerned? Where do you see growth levels to begin with?
Supriya, we already have growth estimates, the advanced estimates of growth from the CSO, which is the most competent body to make those estimates. So I doubt if the economic survey can really add to that. In fact, if it did, I don't think it would carry much weight. Having said that, in fact, the survey over the years has become largely of limited importance, primarily because now we have such a lot of information coming out from various sources. The mid-year review of the economy itself came out only in December last, which is just 2 months ago. So I doubt if the survey can really add very much more by way of information. What it could add and what it does read is more like a wish list of an economist. It's more an academic approach to the economic issues facing the country. So I don't think anybody other than the economic advisor himself and maybe his office takes it too seriously. Having said that, it's good to know what an ideal world, an economist's ideal world would look like. And then, of course, it gets colored by the political economy of the day, because governments ultimately, at the end of the day, have to answer to the electorate and not to economists.
That's a fair assessment indeed. In my Maithili's assessment, Swami, it's only Arvind Subramanian who cares as much about his survey as the rest of us do. But if I were to ask you, and Arvind Subramanian is one of the voices here in North Block and also in the public policy making space right now, who are in favor of expanding the fiscal deficit and vehemently in favor, really. He goes on to say, if you're not going to expand your fiscal deficit, if you're going to stick to the target, it is going to serve no purpose. And he said it time and again. We'll, of course, wait and watch what he does in his economic survey right now and what is the cue that Finance Minister Jaitley will take in the budget. But just to talk about his views that are out in the public domain, fiscal deficit expansion, what do you expect the survey to say on that? Do you expect Arvind Subramanian to continue with his position that we should loosen up a little as far as the deficit is concerned? Swami?
I have a feeling Arvind may not say very much on that at all because the budget is due. And I think on the fiscal deficit, he would not be want to seen disagreeing with the finance minister 2 days from now. So perhaps he won't say very much about the next year's deficit. They may talk about the current year's. But certainly Arvind may consider what is the case for retargeting the fiscal deficit. The point he has made again and again is, he says, look, it's not just a question of do I reduce or don't reduce. He's saying, let us reduce at a more leisurely pace. So he's saying, I'm not against fiscal consolidation, I'm all for it, but let's not do it too quickly. And let us do it at a slower pace. The only problem is that, you already put off that 3.5% target once. Jet Li did it. If you do it a second time in 3 years, then, you're welcome to say, no, I'm still on the same path, just a little more slowly. But somebody will ask, at this pace, are you really on the same path? Are you trying to avoid being on that particular path? Various issues of credibility arise. Now, there's some fine tuning that economists will go into. You'll say if you go from 3.9 to 3.7, I'm still on the path of consolidation even if I haven't gone to 3.5. There are various ways in which you can spin this to saying this is fine tuning and not diverting from the path. It is possible that Arvind will argue along those lines. I will simply say that as far as the world economy is concerned, if you stick to your targets, it will be a much better signal than sending something else to saying, no, please don't say I'm not on that path, I'm still on the same path, etc. I mean, to have to explain things to you in this complicated fashion at a time when perhaps $1 trillion are going to flow out of emerging markets in 2016. I mean, that is the scenario you're facing. In that scenario, you shouldn't get caught up in fine-tuning and nuances. Much better to be blunt. And at the end of it all, if you say 3.5 and with a burst of public investment you end up at 3.7, nobody is going to criticize you. So why start with that 3.7? Start with the 3.5, and if you really can do a burst of investment, which I'm skeptical about, the ability of this government
Swami,
to
I will
suddenly...
have to interrupt you there because Jayant Sinha is making a statement in Parliament and I think we must go across and listen to that. He's apparently speaking on NPAs.
कि जिसमें कि किसी को कोई शंका ना हो कि हमारा बैंकिंग सिस्टम एकदम दुरुस्त है। हम लोगों ने इंद्रधनुष के द्वारा सिस्टेमिक रिफॉर्म्स हम लोग लाए हैं और पूरी तरीके से हम लोगों ने कहा है कि बैंक का रिकैपिटलाइजेशन होगा। धन्यवाद।
अनिल चिरोल, यस, नो, अनिल चिरोल जी को बोला है।
Thank you, Madam Speaker. Whether the government has considered developing sector-based lead indicators.
All right, so that's Jayant Sinha making a statement on the floor of the House as far as NPS is concerned. Remember, this budget and this economic survey is being presented at an unprecedented time when there is this raging debate as far as India's bad assets in the banking system are concerned. Many people wondering if there are systemic risks in the making. But we were talking about the fiscal deficit, and we're joined by very eminent people right here. Mr. Rakesh Mohan joins us on ET Now, and so does Dipali Bhargav from Credit Suisse. But Maitli, before I go to them, I must come across to you because I know Swami and you have very divergent views on the fiscal deficit debate. And like I said, because Arvind Subramanian has been one person who's been speaking about losing the fiscal deficit, you seem to vote more in favor with him than Swami right now, don't you?
Well, absolutely. And in fact, I think human memory is so short because what we don't remember is that Arvind made this very same argument in the last time's economic survey. And I quote from the survey, he says, last year's survey said that even as the government would abide by the 4.1% fiscal deficit target, the time is ripe for reviewing the medium-term framework and setting targets for the upcoming year against that background and taking account of the lessons of recent history. This is a point that he repeated in the mid-year economic analysis that he presented in December. So it's very well known that he is in favor of taking a slightly more relaxed view. And I would tend to go with him because if you look at the original FRBM target, the original deadline was 2008. And mind you, we're well beyond that. It was Mr. Chidambaram, in fact, who doubled the fiscal deficit. He first pressed the pause and then he completely gave...
All right, there's breaking news on your screens right now, and the macroeconomic survey has indeed been tabled in Parliament as we talk. We are going to get in more details from the survey in just a moment from now, but we are given to understand that Mr. Jaitley has indeed tabled the survey. The GDP growth for the year next year has been targeted at 7.7 to 7.5%, and this is exactly what we were discussing. So that's the GDP target as far as the macroeconomic landscape of India is concerned, much lower than what it was last time. So it looks like the headwinds are here to stay as far as the Indian economy is concerned, or at least into the CA's assessment. So 7 to 7.5%, and that's quite a climb down from 8 to 8.5%. Let's take it across to Mr. Rakesh Mohan, who's joining us right here on ET Now as well. Mr. Mohan, thank you very much for being with us. Growth targets being revised to 7 to 7.5% is really what the economic survey has said here. This is a climb down from 8 or over 8% growth that was projected in the economic survey last year. Your quick take then.
Is that 15-16 or 16-17?
This is fiscal year 17. Growth is being seen at 7 to 7.5%.
For fiscal 17?
That's right.
Yeah. Well, given the global economic situation, I think that 7 to 7.5 is a pretty respectable expectation. I would like to see much more in terms of the composition of that growth and how they think it will come about.
All right. Let's take this across to Deepali Bhargav as well, who's joining us from Credit Suisse right here. Deepali, what's your quick take? Can we go across to Deepali, please? All right. Swami and Maitri, let's come to you then. Swami, 7 to 7.5% for next year. It looks like the headwinds are actually weighing over the tailwinds that Indian economy did see from the commodity crash. What's your take on 7 to 7.5%? Disappointed with those numbers?
Given the global slowdown, it's a realistic target. But I would like to point out that while this is approximately the same as the current year, it means that the non-agricultural part is going to be slower. Without doubt, the agricultural part should be much faster. After 2 droughts, we're probably going to have a reasonable monsoon. So if you keep the same target, we are really saying that on the non-agricultural side, we are in some trouble. I think that's a realistic assessment of what is going on. This is, I think, a particularly difficult year to call. It is possible that ultimately the US economy's upsurge overwhelms the other negative factors and we get quite a good year. It is possible that it doesn't work out, that the travails of the international banking system, even in Europe, even in Japan, even in the USA, tend to pull down global growth. And we really go quite seriously downhill. Both those possibilities are there. It's a difficult call. If it goes downhill, then even getting to 7% in India, I think would be difficult.
So 7 to 7.5% is a realistic target. I must welcome Sonal Verma, who's joining us right here on ET Now as well. A realistic assessment according to you, Sonal, 7 to 7.5%, like Swami is pointing out, given the global headwinds, given the fact that one cannot really put their finger on the robustness of the recovery in the US economy, a safe number to go with, 7 to 7.5%?
It's definitely much safer than the 8+ number that was projected for FY16. Our own sense is that the final number could be at the upper side of the range that they're projecting rather than the lower side. The external headwinds have actually been in place even for the last 1 year. What has incrementally really changed is the financing and the tighter financial conditions that we've seen because of capital outflows, the correction in the equity markets, even in the bond market. Interest rates have hardened a bit, and therefore the financial conditions actually have tightened at the margin, which does not bode well for private investments. I think on the other hand, next year we are expecting a normal monsoon. If we do get that, then we could see some pickup in rural demand in the second half of the year. And we of course, are expecting the stimulus from the 7th Pay Commission, which would also support urban consumption. So on the whole, I think numbers obviously a lot more realistic than last time. At the same time, I think consumption will likely continue to be a driver of overall GDP growth next year, but private investments could be a bit on the weaker side.
I think some of the flashes that are beginning to come in now do say that CPI for the fiscal year 17 is likely to be in the range of 4.5% to 5%. And they've also made a statement about how the 7th pay panel recommendations will have little impact on prices or on inflation really. Maitri, very quickly then, fiscal deficit of 3.9% seems achievable for FY16. But I don't think anybody really doubted the fact that fiscal deficit can be achieved this year. So those are flashes that are coming in. Current account gap is expected to be at 1 to 1.5%. That's around expected lines as well. But Maitri, if I may come to you on the inflation bit, CPI being seen in a comfortable range of 4.5 to 5%. That battle finally won, according to you?
Well, it would seem so, but in India, we never win the battle completely against inflation indefinitely. We win it and then we lose it because the underlying pressures are always inflationary. So certainly, yes, we have won a short-term reprieve from inflation, but especially if the Pay Commission, I think it's a little naive to assume that the Pay Commission recommendations, if implemented, will not in any way contribute to inflation. I think they would. But certainly the inflation forces would be less but for the Pay Commission. So given that, if they are assuming that the inflation will remain within that target, clearly it seems to suggest that the extent of underutilization of capacity is much more than what we had estimated in the past. So inflation, clearly we are in safe territory. In fact, enough for the government to be a little bold, and maybe in hindsight, if the Railway Minister knew what the survey was going to say, he could perhaps have hiked the passenger freights, because if inflation rates are going to be so low, then where is the worry about raising fares?
You know, one of the flashes that have come on the screen right now is that the survey does see chances of review of medium-term fiscal framework, and once again it looks like Arvind Subramanian is paving the way for the fiscal deficit revision like he did in his survey last year, and which is after which the government went and delayed fiscal consolidation by Mr. Mohan. If I may come to you, sir, how are you reading into the statement? And just for the benefit of our viewers, I'm going to reiterate that point. The survey sees chances of a review of medium-term fiscal network. Arvind Subramanian making ground for fiscal expansion once again?
Well, I think this has to be seen once again within the context of the global economic framework that we are seeing over the next year or two. As I understand it, in the ongoing G20 meeting in Shanghai, the US Treasury Secretary plus the others, including the Chinese Finance Minister apparently, are indeed arguing for fiscal expansion globally. Of course, within limits and within the kind of slack that exists in different economies. So in that sense, I think that given the situation in the world, it would not be, I would imagine that if there is indeed a review of the medium-term fiscal framework with some relaxation, we would be pretty much in line with other major economies at the current time. Of course, one could argue that we perhaps have less fiscal space than some other countries, and therefore we have to be much more careful than many others. But then, on the other hand, European economies have even less fiscal space than we do in terms of their debt GDP ratios. So I think that overall, I would certainly say that Arvind Subramanian is not wrong in asking for a review of the medium-term fiscal framework in both the current global context and also the slowdown in both private and public, in particular in private investment. And therefore, I think that this is something to look for. I would add further that we should not be concentrating solely on one number, that is the fiscal deficit. I would argue much more strongly for looking at the composition of public expenditure, and if there is relaxation in the targets for fiscal deficit, then it would only be justified if it is due to a jack-up in public investment overall, and particularly, of course, in infrastructure.
Fair point indeed, and I will take the fiscal deficit debate forward, but not without giving the more flashes on your screens right now. India must plan for major currency adjustments in Asia. So that's some kind of a warning that's coming as far as the falling currency is concerned. And the survey very categorically says that Indian growth will face headwinds. There are risks that exist as far as Indian growth is concerned. I'm given to understand I also have Atsi Sheth joining us right here on ET Now. Atsi, welcome to the show. Thank you very much for being with us. So many questions coming your way. 7 to 7.5% is what the growth target for next year is. Do you believe it's realistic? 4.5 to 5% CPI inflation. But the more important statement is that the survey does see chances of review of medium-term fiscal framework. How are you going to read into that statement? What's the fine print saying? Is there going to be fiscal expansion, or will there be no fiscal expansion?
Sure. You know, on your first two questions on the growth and inflation outlook, I think I would tend to agree with the 7 to 7.5. And I think given that we have an inflation targeting framework that has also set inflation targets, which have, this year's has been met, the inflation outlook also that you've flashed on screen seems realistic. On the fiscal side, I do agree with many of the points the previous speaker made, but let me just add another perspective. One is that around the globe, agreed, there are many countries that are looking into fiscal stimulus as a way to sort of revive growth. But they have a different situation than India does, really. India is actually now the fastest growing large economy in the world. So it isn't really going through the same sort of growth pains that arguably others are. And secondly, India isn't facing deflationary pressures. In fact, quite the contrary. In India, inflation is the problem. So fiscal stimulus being discussed elsewhere is in the context of deflation and very low growth. In India, growth is still robust and inflation is still in positive territory. So that's one big difference. And then, of course, the second difference is the fiscal space that India has. Well, agreed. Advanced economies, particularly in Europe, may have much higher debt levels than India does. They fund them at much lower interest rates than India does. So with every little bit of debt that India takes on, the interest paid on it is much higher. And already interest payments consume about a fifth of government revenues, leaving less left over for other government expenditure activities. Increasing debt would simply expand that proportion. So I think India's fiscal space is really quite constrained. So to your point, will fiscal stimulus be introduced? Our expectation is that there might be some slippage in the target for next year, but it's unlikely to be really great given the fiscal conditions under which India operates.
All right, there are more flashes that are coming in, and the survey does talk about increase in wages and benefits recommended by the 7th pay panel are not likely to destabilize prices. Like we just said, prices will have little impact on inflation. It also says recognition, recapitalization, resolution and reform required to comprehensively resolve the balance sheet challenge of public sector banks. So there are statements that are coming on PSU banks as well. I'll come to those in just a bit. But Swami, if I may bring this to you, our speakers have spoken about fiscal deficit, but your good friend Arvind Subramanian seems to be making a case of fiscal expansion yet again. So that's point one. And point two is that the survey very categorically talks about PSU bank recapitalization, recognition and resolution to reform what is now being seen as a twin balance sheet challenge for PSU banks. The fact that this has now found favor and is actually a big highlight on the PIB seems to suggest that PSBs are a big point of concern, not just for the government, but also for the advisor.
Without doubt. As far as recasting the medium-term fiscal framework, there is a perfectly good case for doing that if you go more deeply into the composition. So instead of simply saying this is the fiscal deficit for what purpose? To simply say government spending, to my mind, doesn't go far enough. Some kinds of government spending, even some kinds of government investment, I can say are very high yield and very desirable, and others I can say are very dubious. This great idea of this bullet train. Bullet trains have been a waste of money the world over. I mean, to spend enormous sums of money on bullet trains, if you say for this I must have a fiscal deficit, I say you're crazy. So the question is, what kind of, again, Mr. Gadkari wants to build enormous waterways all over the place. According to the Rakesh Mohan committee, there is no place for waterways in India except perhaps in Assam. So I mean, again, are we going to go on a spree because some ministers favor this sector and that sector, or is there clarity on how productive the investment is? Within that, again, there are people who will say that focus on the revenue deficit, others will say focus on the primary deficit. All of these have a position. I mean, it would be perfectly right to say one number is wrong. But we need greater clarity on focusing these particular fiscal deficits on high productivity investments as distinct from the others. As far as the public sector banks challenge is concerned, this is in a sense something that between Jayant Sinha and Raghuram Rajan, I mean, we are going forward on this. Finally, after all these years, we are going to have a major dose of cleaning up. Mr. Deepak Parekh has issued the warning that in the business of trying to cure the patient, you may render him comatose. I think our political guys are much too clever to allow the coma to happen. But the cleaning up is required. I'm glad we got down to it. So I think the banking corporate results may look horrific, not just for the next quarter, but perhaps for some time to come. Right. But as I said, the cleaning up job needed to be done. The old license permit days that, you know, when the economy recovers, all the loans become good. That no longer applies in this new liberalized economy, and I think we need to recognize that.
I want to throw this to you because I know you don't believe that the patient can, and now that we are all talking medical parlance, I must also say deep surgery is required, but you cannot afford the patient to be comatose. With the way things are going, March 2017 is a deadline and you've got to meet it. Is written in stone, it seems right now. Could the patient be comatose? You don't agree with the approach, do you?
Possibly, and if you see the RBI itself is having second thoughts, which is why they've allowed some flexibility in the SDR regimen just yesterday, because the RBI realizes that it's all very well to take an academic view of things, but the real world doesn't work that way. And what you're really addressing in this clean-up operation, which Swami referred to and is very necessary, is that you're basically addressing the symptom. This is a symptom of a combination of things, essentially the public ownership of banks, which results in government interference to a great degree, which results in the politicization of these bank boards, and is also the consequence of the RBI's own sins of omission as well as commission for a variety of reasons. So I think as long as you address both the symptom as well as the cause of the disease, I'm fine. The problem right now is that we're addressing only the symptom and pretending that everything would be all right. It's like dyeing your hair. Maybe if I were to dye my hair, within a week or two, it'll again turn grey in salt and pepper. So I need to address, and the answer to that is youth, which I can't get. Neither can the banks, but there are solutions. I think that's what we need to look at.
You know, when Arvind Subramanian said that he's going to have revolutionary ideas in his survey, I think he was referring to the flash that just came on your screen right now. He's saying reasonable taxation on farm and realty income is perhaps warranted, really making a big case, perhaps a very a political statement that politicians will be very uncomfortable with. Mr. Mohan, if I may come to you, finally we hear in a policy document of sorts, things being talked about taxing farm income.
Well, let me, before I come to that, let me first say that I agree completely. I want to just endorse what Swami said in terms of the composition of the expenditure and also within public investment, to be careful about what we invest in. And we should not be that wasting money on bullet trains and inland waterways, etc., clearly to be avoided, and you have to be really looking for public investment that has positive returns and has higher productivity. Having said that, I also just want to first make comment on the banking issue, that once again you need to look at the composition of the NPAs that have indeed arisen in such large measure over the last 2 or 3 years, and some of them are to do with excessive focus on PPPs and infrastructure, much more than almost any other country has done. And so one needs to also look at that composition of NPAs. Some of the NPAs are due to the global downturn, particularly in commodity prices, steel, etc., and some of it to do with infrastructure projects that have not really got off the ground or gone bad. And then, of course, there's a third part, which is indeed to do with particularly bad lending to bad promoters, not doing enough due diligence, etc. So once again, I think that it's the same issue, like in the composition of the fiscal deficit, that one needs to look more carefully on where is it that the public sector banks have particularly gone wrong, how much of it was due to government behest, and being public sector banks, they of course have to listen to public behest, government behest, and how much was it due to bad due diligence, bad decision making, etc., as we look into cleaning up the balance sheets of the banks and also doing banking sector reform. Then coming to taxation, I'm of course just waiting to see what indeed the Economic Service says, but some of the work that I have done and published in some papers, that Indian tax GDP ratio really is much lower than even comparable countries with comparable incomes per capita, and therefore excuse me, any tightening of taxation, whether it is to bring in agricultural income, realty income, but I would say much further actually, that looking at the number of cars sold and things like that, that is very, very clear that there is huge underreporting in income tax, and therefore any tightening of taxation is absolutely necessary.
Right. Mr. Mohan, just hold your thoughts there. I want to get it to Atsi Shade once again. And Atsi, more flashes coming on our screens right now. FY16 subsidy is likely to be below 2%, and that's something that people like yourselves watch like a hawk. So subsidy bill could be below 2%. That's an important part that's coming in. And the second part, like we were discussing, the survey very categorically says that the tax base has to be widened to 20% from the present 5.5% and making a very revolutionary statement of sorts there to tax farm income, and the time has perhaps come to look at taxing that bit. I know, commentators like yourselves have for a while said that India needs to widen its tax base and do the things that are possibly, possibly the survey is talking about. How much of this is going to be feasible? Does this cut ice with someone like you? I mean, these are very good things to say, very good things to put in the survey. Can they be a reality in a political economy like ours?
I think that is a good question. But if you look at what the Indian tax revenue base has done over time, you've seen, for instance, services. They began their contribution to GDP much before they began their contribution to the tax base, in fact. So services tax net expansion happened after services actually accelerated quite a bit. What the survey seems to be saying now is that there are other areas where GDP growth is robust enough to be it's making contribution to GDP, but this economic activity isn't contributing to the government's coffers, and that is where the government should focus. So I think that's a very reasonable case to be made. In a political economy like India's, can it be implemented? Sure it can. It has to be, as it is done elsewhere in the world. No one anywhere in the world wants to be taxed. Governments, have to tax the public at some point, and they can tax that segment of the population that is making so much more now and has some sort of incentive to become part of the formal organized economy, and that means being recognized as a tax contributor. And India is certainly on the cusp of this structural shift, where there is the sort of the sector that was small and medium household enterprises that are now growing to such a scale that they're actually gaining that much income, and they can certainly make that contribution. So I think in principle, of course, this is an idea that's been implemented elsewhere as economies have accelerated in terms of growth rate. But of course, the proof of the pudding will be in how it's implemented, and that's an administrative issue, not a theoretical issue.
Fair point indeed. Sonal, I'll come to you because some of the stuff that's coming out, and just for the benefit of our viewers here, the survey very categorically says that growth that could be in the range of 7 to 7.75% in the coming year. Survey predicts over 8% growth in the next couple of years. And of course, the other points is about the PSU bank recapitalization. Reforms are needed to resolve the bank issues. RBI should be able to meet the 5% inflation aim by March 2017. It also very categorically says that the current RBI policy rate seems neutral. Is the survey making the governor to be a little more benevolent here, Sonal?
Right. Actually, if they're saying that the Reserve Bank policy is just about neutral, whereas the Reserve Bank has actually been saying that the policy stance remains accommodative, then they are perhaps, and in fact, if the inflation forecast that they have for 15-16 is 4.5 to 5, which is basically indicating that the RBI's 5% target will be undershot, then they are actually making a case for more monetary easing in FY17. Now, I mean, there are two issues here. One is whether indeed monetary policy is neutral to or accommodative, and there can be a lot of debate on this. And second is whether indeed inflation will be 4.5 to 5%. What we've seen in the last 12 to 15 months is actually inflation's been around 5.2, 5.3%. It's actually been quite sticky despite the positive global environment, despite the lagged effects of output gap being negative, MSPs being brought down. We've actually not seen inflation sustainably break below 5%. With oil prices now actually starting to stabilize, I think the 4.5 to 5% inflation projection is optimistic, and risks are actually on the upside. And one thing not to forget, actually, when we are making inflation projections for next year, is that the pay hike will have a direct impact on the CPI inflation because of the higher housing rent allowances. It's a technical reason, nothing that has implications on monetary policy, but that means that the average CPI inflation is unlikely to be actually under 5%. And second, like Maithili said, essentially the budget is arguing for a deviation from fiscal deficit targets, but the composition of expenditure in our view is likely to be largely geared towards consumption rather than so much towards investment. So if it's a consumption stimulus that we are ultimately going to give in FY17, then I think we need to keep our eyes open on the indirect effect that this could have in an economy where, despite everything that can go right on the inflation front, has gone right globally and domestically, expectations still seem to be quite high. So I think while the growth numbers may be more realistic, the inflation numbers actually seem optimistic to me.
Atsi, you agree with that? Inflation numbers seem a tad more optimistic because the argument about fiscal expansion is also veered towards consumption, and that will only stoke prices higher. Do you essentially agree with the Sonal here? 4.5% to 5% is an ambitious target as far as inflation is concerned.
You know, in India, every time you sort of target a lowering of inflation, that's an ambition, because India is vulnerable to inflation, and we know that from its economic history. So one of the things that I would bear in mind is that 4.5% inflation is achievable if you don't have another drought and food prices, for instance, come off significantly from current levels. I mean, I think that's the one thing that really does determine the upside and downside risks to inflation in India quite significantly. The second is what your anticipation of monetary policy is. So if you believe that the RBI is really committed to its monetary policy targets, then it's easier to believe that this sort of 4.5-5% will be met, because you'd expect that if inflationary trends are indeed accelerating at some point during the calendar year 2016, the RBI, as it has in the past, will take action to halt those trends. So I think that what the inflation target is, or the outlook that they've put out in the survey, is believable depending on your assumption about monetary policy actions and your assumption about food inflation.
Swami, you want to come in on that quickly? The monetary policy assumption, and the survey very categorically says it's neutral, doesn't say it's accommodative, just like Governor Rajan and his team has been arguing. So one question there. And the second question really has to do with, it seems the survey is a little, it's trying to bind the government within that fiscal constraint. On one hand, the survey very categorically says that there could be need for reviewing fiscal management on one hand, and then on this very second account it says credibility is an issue, and credibility argues for adhering to 3.5% target. How do you read these two lines? They're almost caught between the devil and the deep blue sea.
Yeah. Actually, first on that earlier point about taxing agriculture, agricultural income is a state subject. It cannot be taxed. What the central government can do, perhaps, you can, for instance, put a tax on unbuilt land. I mean, land speculation, which takes place with people building up land banks. I mean, if somebody is just speculating in land without actually using it productively, taxing unbuilt land is a huge area where I think there is possible income to be got. Secondly, I mean, if you are now on acquired land, if you are giving 2 to 4 times the old price, why should there not be capital gains tax on acquired land? I mean, it seems to me those are two areas where definitely we can move on the land side. On the monetary side, well, I would simply say there are a large number of uncertainties. On the one hand, we have had this large collapse of import prices in 2015. There are two views on what's going to happen in 2016. Some people think this is going to continue to be this bad. Right. Lots of other people are talking of oil bouncing back to 45 to 50. If that happens, the level of inflation in India will tend to get pushed up because the favorable factors of last year will go away. I will simply say that I would not hazard a guess on prices. It is a highly volatile thing. It goes up and down. I would also add that there are virtually no other countries in the world where you can have a difference of 700 basis points between the wholesale price index and the consumer price index. And people wonder whether this is a real country, whether you have a situation where those two indices are so wide apart. It raises a question as to whether you know what the devil is going on in the economy.
Right.
The credibility issue that you raised. As I said, the credibility issue is being raised because Arvind Subramaniam is trying to emphasize that this is a matter of nuance. He says we want the credibility that we are on the consolidation path. At the same time, we want the flexibility to be on that credible path, but going a little more slowly. I think this is the attempt. You are trying to balance those two and get together. I would simply say that in the current global conditions of panicky foreign investors, nuance, this is not the time for nuance.
This is not the time for nuance, and one needs to take a very bold call on maintaining fiscal deficit, is the word from Swami. But you know, the another figure that's coming up is that PSU banks will need 1.8 lakh crore capital infusion by 2019. That's a lot higher than 70,000 crore that was committed by the government this year. Maithili, very quickly then, 1.8 lakh crore looks like a daunting amount of money.
Well, absolutely. And the question is whether this is the best use of taxpayer money. I personally think it is not. Unfortunately, as I said, because even if you recapitalize them, again, a similar situation will arise just a few years hence. We had very high NPAs of close to 14% in the late 1990s and the early 2000s. And growth was the ultimate answer, which reduced those NPAs dramatically. So I personally think it's a huge waste of government money to recapitalize the banks, particularly because, in fact, the RBI's insistence on more than preemptive provisioning going beyond Basel III is adding to the extent of capital that is required at the banks. So I think this is something on which the government needs to have a strong rethink, particularly because these are all in the public space, whereas unlike abroad where Basel was essentially designed for banks which are in the private sector. So Government of India and State Bank of India are frankly no different. So I think one needs to look a little realistically at the Indian situation and see how best we can tailor it to our own requirements.
All right, best how to tailor it to our own requirements. Jayesh Mehta is also joining us here. 1.8 lakh crore is worth of PSU recapitalization that the government will need to do, is the suggestion that's coming in from the survey. And like Maithili is saying, that's a lot of taxpayers' money, bad money being put behind, bad money now is going to follow good money. What's your take on this entire issue? Do you think there's any getting out of PSU bank recapitalization, or is that inevitable, that's imperative?
No, it had to move, right? Even if the current move would not have happened, you will have to recognize NPA as we move to Basel III. Yes, but I will just support what Maithili is saying, that preemptive provisioning at this juncture, maybe from a timing perspective, that's good. Preemptive provisioning, you do it at great times, it's a different story. But at this juncture, preemptive provisioning could be overbearing, especially when you are already stressed. So that's the only small point I had. But ultimately, the requirement for capital would have been there, recognizing the right NPAs would have been there. And yes, while we work looking at the current judicial system, maybe one of the biggest way to get this over is to have growth. And that's what the focus should be. And growth not only for the country as well as for the banks, also for expanding their balance sheet. And when I say balance sheet, not necessarily always by loan, it could be, at times of stress, in past we have seen that when banks were a little bit stressed, they had capital problems. They were still growing, but they were growing by maybe government bonds. So from that perspective, the growth has to be kept momented. And that's where I think we are not seeing any growth in the bank's balance sheet also. So I think that's also a challenge. Some people would require capital immediately. Some banks would require capital immediately. I think for the next financial year, people looking at around maybe 35,000 crores is that sort of number. Hopefully, if that is suffice for next year, and we have to at least see that in next 1 year we try to build up, provide some growth in the economy and in the bank's balance sheet.
Jayesh, hold your thoughts there, because I want to take this question to Sonal Verma, and I want to go back to the global headwinds that this survey does point out as far as India's economic growth is concerned. Two big things. The survey suggests that one tail risk scenario that India must plan for is a major currency readjustment in Asia in the wake of a similar adjustment in China. So I really want to ponder time there and talk about that. And the other tail risk scenario that could unfold as a consequence of policy actions is capital controls taken to respond to curb outflows from large emerging market currencies, which could further moderate growth. How do you read both these statements, Sonal?
Right. I think particularly, of course, in the current weak global environment, there is a risk that increasingly countries become a lot more protectionist, and this can show up in different ways. It can show up through capital controls. It can show up through, trade barriers being erected. It can show up in terms of even, FX management towards keeping currencies a lot more undervalued. Therefore, on the aggregate, what it implies is that the pool of available global demand is probably going to be stagnant or is actually going to shrink going forward. That is one. And second, if China, and the survey here, particularly refers to China and the risk of further weakening of the yuan. It will have an implication for most Asian currencies, including India, because on a real effective exchange rate basis, actually INR has been appreciating, which has probably, could be hurting our competitiveness at the margin. And therefore we need to prepare for it. But the question is, how do you prepare for it? Are you going to also depreciate your currency in order to get back the market share? And I don't think that is really going to work for India right now, because if you look at the last 10 years, INR has depreciated by almost 80% against Chinese yuan, yet we actually still import more from China and export less to China. So I think the issue with India's competitiveness have got to do very little with the exchange rate competitiveness and a lot more to do with the competitiveness which comes with the ease of doing business, the other costs of doing business, which really adds up to the aggregate cost. So I think in this world of sort of competitive devaluation and protectionism, the focus of policies in India have to be towards boosting productivity and competitiveness. Otherwise, it's a zero-sum game and it's not going to get us any benefits, especially for a country like India, which is still struggling with a 5%, 5.5% inflation. The answer to this global scenario cannot be to devalue your currency.
Or the answer cannot be to devalue your currency. But Atsi, I will come to you with the two statements that have been spoken about as headwinds as far as India's growth prospects are concerned. How do you read statement number one, which is the major currency readjustment in Asia could be a big headwind as far as India is concerned? What is the survey really prescribing as a way forward?
Well, currency adjustment would be the obvious sort of takeaway from that. And it's true, as Sonal says, the sort of market tends to focus on dollar exchange rates with any currency. And in dollar terms, of course, the Indian rupee has depreciated. But if you compare to what has happened in even regional trading partners like, say, Malaysia or Indonesia, whose currencies have depreciated a lot more than the rupee, India has lost currency competitiveness. Now, again, as Sonal said, having that currency competitiveness in the case of Indonesia or Malaysia, for instance, hasn't led to a robust export response. That is, their export, simply because those currencies have depreciated, they are not exporting more, and that's partly because global demand conditions are quite subdued. So the interesting question for India is that, okay, it doesn't have the currency competitiveness, but even when it did, when the rupee depreciated, which was, I guess, the last time that it happened dramatically was in 2013, there was actually an export response. So I would say currency depreciation does matter, and you can get that export boost. But in the current environment where, global demand is low, where other currencies are likely to depreciate as much, that is not going to be a lever that gets you as much out of it. The second puzzle for India is that given that India's income levels are much lower than all these trading partners, including China, it should have wage competitiveness. So India should be more competitive simply because its wage levels are so much lower than most of its trading partners, and yet it isn't. And therein lies the problem, that it is because cost of doing business is higher in India, and that is because inflation is higher in India. So really the competitiveness in India, if you want to address it, you have to bring down the supply side barriers to lower inflation, not just the demand. What's happened in the past is that when inflation goes up, demand is curbed through monetary policy, and that's one way of curbing inflation. But until you sort of address the supply side barriers, that competitiveness is not really going to come back. So I think that's maybe that's not the message of this survey. The survey is really talking about exchange rates, but if you want to talk about competitiveness, you have to talk about supply side issues. On the capital controls question, I think, again, were there to be capital controls, and certainly our baseline is not that anyone's going to impose them imminently, but one emerging market imposing capital controls, the market is not going to be nuanced about it and say it's specific to one emerging market. All emerging markets will be hurt, just as India was when it was the commodity exporting emerging markets that had trouble, but all emerging markets suffered. Similarly, if one emerging market were to impose any policies the global markets considered as sort of detrimental or a step back, India would be hurt by that. So I think that the economic survey is right in pointing that out.
All right, the economic survey is right in pointing out the capital control curbs, and like Apsi is saying, the baseline scenario doesn't really figure that much, so much. But Jayesh, if I may come to you and talk to you about the major currency readjustment that that the survey does talk about. What's your takeaway from that statement? I mean, Sonal and Atsi have made their points. I just want to get you involved in this discussion and talk to us a little bit about India must plan for a major currency readjustment in Asia in the wake of what China really did.
No, I will. I have a very different thought, which is somewhat similar to Sonal, right? We always keep on saying export competitiveness and all that. So, what's our major export? Our major export is services, right? And that's not easily replaceable. You have a manufactured good, currency would immediately impact. You may move from one country to another. This, of course, in a longer term basis may impact, but on a shorter term basis does not impact. Secondly, when we look at currency adjustment, we look at point to point and we feel that India has not really depreciated but is really appreciated. But it depends on which point you are taking from. Maybe if you're taking from 3 years back, 4 years back, where is that you are taking from? If you're taking from just last 6 months, maybe yes, India is not depreciated, but then take it from 3 years or 4 years. So I think, we always have, and this is not now, this always, we have been talking about export competitiveness, but what's our export? Is it really linked so much to the currency? And especially in this current situation where global demand, global world, globally people are talking about deflation, global demand is killed. India, we do have demand, and therefore what we need to do is ramp up Make in India. And of course, that again is come back to the situation where the current risk appetite for investors, the capex, all that is not really there, and that's why we need pump priming, which will have a fall through impact to private sector to make in India more. So I think that's where it's all boiling down to. So I think currency depreciation, maybe reaction to if China depreciate more, but do we really need that much? I don't really think that we need currency depreciation to be making it export competitiveness.
Fair point indeed. Just hold your thoughts there. I want to, for the benefit of our viewers, quickly recap everything that the survey has said so far. So growth for next year likely to be between 7 to 7.5%. Inflation levels at 4.5 to 5%, which a lot of our experts here believe is way too ambitious. The survey also talks about CAD between 1 to 1.5%. As far as fiscal deficit is concerned, the commentary is making a very nuanced case of managing the fiscal. So on one hand, it says credibility, argues for adhering to 3.5%, and then of course it talks about reviewing the fiscal management exercise completely. The survey, in a very revolutionary way of sorts, just talk about widening the tax base to a steep 20 from just a 5.5% right now, talks about phasing out tax exemptions completely, also talks about taxing farm and realty income, and does say higher tax on realty will help prices. Let's take this across to Dr. Arvind Virmani, who's now joining us on the show as well. What is your broad takeaway from this economic survey? Some game-changing ideas like the taxation bit, but essentially making a case for fiscal expansion nonetheless, like it did last year?
So the way I view the economic survey is really in the perspective of the survey last year, which, if you remember, talked about a sweet spot in the global economy. I think they went much too far, and I said it after the last survey. They are now compensating for it by bringing out. So basically, you looked at the rosy side of the global picture last year, which was oil prices going down, etc. But we ignored the negative part of it. Most people did. So this survey, in fact, in my view, goes the other way and perhaps is trying to overcompensate. But let that aside. I think most people seem to think it's doing the right thing, but I think it's overcompensating. But there is a gloomy side to the global picture, which I pointed out almost a year ago in an article, that the same factors which are giving lower oil prices are also causing other problems in the global economy. So anyway, so that's a good thing actually. The compensation needed to be done. That's the first point. The second point on the fiscal, I think perhaps most outside observers are reading more into it than is warranted, because the economic survey actually cannot give you a hint about what exactly the fiscal deficit would be, because Parliament would take objection to it after the budget. So I would leave that a little skeptical right now, that there are two approaches.
Right.
One is the one I have, yeah.
Dr. Vermani, just hold your thoughts there, because I want to throw it to Avan Dubash to quickly check on the markets and then come back and discuss more of the economic survey with our expert panel right here. Avan, over to you.
After the economic survey has been tabled, it's pretty quiet for the equity markets. In fact, it would be interesting to just pull up the intraday chart of the Sensex and the Nifty as we speak. 7,012 is what we're latching onto. So after that dip sub the 7,000 mark, you are seeing a recovery, but it's consolidation mode that's on in full throttle. I don't think that too much has really been taken away by way of positives from the economic survey that was tabled, and rate sensitives in particular are in the limelight. You've got the Sensex up about 130 points, but let's talk sectors. PSU banking stocks are continuing to hold out in the green. It's a gain of about 2%. It's your top performing sector still. You've got the finance sector, which is doing well as a whole. FMCG is up about 0.6%. The infra pocket, IT, those have been your performers from the word go, and they're continuing with the traction right now. And perhaps it's these sectors which is what's keeping the Nifty and the Sensex afloat at a time when the broader end of the market is moving on a complete tangent of its own, down by 0.6% for the small caps. You've got auto as well as the consumption sector, which are currently in the red, and big laggards in the form of Bajaj Auto, Hero MotoCorp, Grasim, Idea Cellular, Tata Steel, while all of the banking names are moving quite strongly right now. SBI, Axis Bank, it's a 3% gain that you're seeing in some of these names. In fact, let's get in Dr. C.K. Narayan, who joins in with some technical perspective. 7,000 being sustained, but it's not a very convincing move on the index, Dr. Narayan. What are the levels that you're mapping over here?
See, I think the action around 7,000 seems to be, like you correctly mentioned, a little bit decisive ahead of the budget. And if you look at the option positions also, as we begin a new month, the largest concentration of option positions is at the 7,000 put strike, indicative of the possibility that the market wants to create a base around this level of the index. Now, whether it wants to go up from that is largely to be decided, I think, on Monday, rather than the market is not really having any major takeaways from the economic survey. None was really expected in any case, because it's more of a concept document rather than something very, very concrete or implementable in the immediate future. In that sense, I think we are going to remain range bound with about 7,000, 7,010 at the lower end and about 7,080, 90 at the upper end for the day, and perhaps the rest of the day may also go in a pretty ranging fashion as far as the indices are concerned.
Okay, that's the call on the index, and in fact, it's been a fairly crucial week of sorts. We've had the expiry, we've had the Nifty really breaking crucial levels on the downside. It's been volatile for the currency, the economic survey, and pre-budget jitters is how you can describe it. And that's the reaction for the Nifty after all the give and take, or rather take, that's it, all it's been. It's been a gash run of almost 2.6% for the week gone by. Dr. Narayan, walk us through some of the top stock recommendations that you're advising our viewers.
At the moment, we still have a slight bearish bias for the day, even though right now the market is indeed rallying. For the short side, I am looking at Arvind Limited at about the current price level of about 255. We could probably look to short this with a stop placed around 258 to 259, and we can expect a drift down towards 245 levels before the day is out. The second stock for a trade is a new listing in the futures from today, which is PC Jewelers. PC Jewelers had been into a sideways consolidation, but then seems to have slightly given way under some fresh selling pressure soon after commencing trade on the future space today. So the current price level around 335, I would recommend a short. Stop loss at about 340, 342, and looking for a target at about 325 before the day is out.
Okay, thanks for walking us through your picks. Keep an eye out on the index. We're picking up a bit of steam, 7,020 on the Nifty with the Sensex up a good 157 points. It's quiet for the broader end of the market. And with that, I'm going to hand it right back over to Supriya Srinath in conversation with our experts. So, Supriya.
Thank you very much, Avan. And Dr. Virmani, I'm going to come to you because some of the fine print that's now emerging from the survey is actually quite bold. I wonder if it's paving the way for a bold budget come Monday, but may not go down very well with the political class. It says there is a case for replacing MSP with direct cash transfer. It also says large farmers should be procuring urea at market prices. It had earlier talked about the suggestion of taxing farm incomes. Is this going to be politically palatable in an economy like ours, or are these suggestions that will remain there for Economic Survey 2016?
So let me give you a perspective, the way I would have looked at it. We know that the government has been carrying out LPG reform, in the whole subsidy transfer system. And we also, all of us know that there are three major subsidies left: food, kerosene and fertilizer. So I would expect the economic survey, given there is interest in reforming these three remaining subsidies, I would expect the survey to give us some idea of what is a good way to go about it, keeping the political realities in mind. So I haven't seen the survey, and from what I read on the screen, there is something on two of these subsidies. So I would see it as a kind of a menu which is out there, and hope that at least they will proceed on one of those reforms. That's the way I would suggest that it be read. Not necessary that they will do all three. They may do one, which would be a very good positive, but they could also disappoint and move too slowly by saying, okay, we'll do it a year from now or 2 years from now.
A year from now and 2 years from now is going to be election time, and I wonder if any government is going to have the political appetite to do this, if not in this budget. But Swami, like Dr. Virmani is saying, out of the three, even if one is done, he will be happy. You think the political class will have the appetite to bite the bullet and do any of the three possible?
Kerosene, yes, it's possible. Fertilizer, doubtful. Food, impossible. I think I would sum up in terms of political feasibility. On food, you see, if you do a cash transfer to the farmer, it means you are no longer doing a procurement. If you are no longer doing the procurement, then what about the consumer? The answer is you will have to give a cash transfer to every consumer as well, and then dismantle the public distribution system and leave everything to private trade. So it can't be done sectionally. So that is a huge undertaking. So I mean, that I would say is out of the question. Fertilizer is too tricky to be grasped, I would say, within the next 2 years. I have seen suggestions of somebody saying, why don't you give 1 or 2 free bags of urea to every farmer, and beyond that market price, something like this. Maybe you can try some kind of pilot project, but to make it universal by the next budget, I would say. Kerosene, I think we are already moving in that direction. Kerosene was supposed to be there as a substitute for non-electric areas. Electrification is going everywhere. People are beginning to give LED lamps, solar lamps. So to phase out kerosene into cash transfer or an outright grant of a solar lamp, that I think is feasible. We should go there.
All right, we should go there. But let's take it across to our panel and get quick closing comments from each one of you. Atsi, I'm going to begin with you. This is a bold economic survey. I mean, to be fair to Arvind Subramanian, he has put in some really bold measures out there, and it's up to the political class what they make of these measures. But if I were to ask you, has this set the stage for a bold budget? And does this impress Moody's at all?
Well, India has no dearth of bold and very interesting intellectual ideas that come out in the policy realm. And this survey, although I haven't read it, sounds like it might contain many such ideas. But in a sense of sort of policy making, I think given India's economic structure, given the administrative constraints, policy tends to proceed in small steps rather than giant leaps. And that's not necessarily a bad thing. It just is the way it is, that policy will proceed in small steps. But those small steps, if they're guided by a bolder vision, can be better steps than small steps that are not guided by a bold vision. So I'll leave it at that.
All right. Jayesh, very quickly to you then. The survey does talk about the two big elephants in the room, fiscal management on one hand, and it tries to steer through credibility as well as a need for expansion, and then of course PSU bank recapitalization, but putting a daunting figure there. Do you believe the survey in some sense is pointing out to a budget that's going to focus on similar issues?
No, so survey is suggesting what's the nice thing to do. It's also, but while doing that nice thing, the expected nice thing, which is sticking to fiscal consolidation and bank recapitalization, is also, putting up the difficulties of that. I think maybe one way to look at it, we really differentiate fiscal, monetary, and all that. So when the country typically in a non-so-normal times, and currently the world is not in the normal times, I think it has to be together. Maybe this time round they will have to stick to the headlines because they don't want to upset the generally said so-called good things to happen. But at the same time, you need to have a fiscal and monetary policy to be in sync. And one of the things, like while we are all talking about pressures on the bank, it's also pressures coming not only through NPA, it's also the yields and the liquidity. I think after cutting 125 basis point rate cut, how can you have the same liquidity management? You had 150,000 crores negative when you are raising rates, it's the same negative when you are cutting rates. So that's something, I don't want to go into numbers and economic argument, but I'm just talking as a layman that how can it be the same, right? So that's the point I would make it. So I think it's fiscal and monetary has to work together. But looking at what survey is suggesting, I think we'll stick to all the tick marks on Monday.
We'll stick to all the tick marks on Monday. Dr. Virmani, you've scripted many surveys in the past. Does this one leave you impressed? That's question number one. And question number two, like I asked both Maithili and Swami, how much of it is going to be politically feasible according to you?
Well, I think you have to understand that economic survey cannot reflect anything in the budget because that is a parliamentary privilege issue. I have seen it. I was there once it happened. About 10 or 15 years ago. So it's really the thinking of the CA. I mean, with some finance ministers gave me complete freedom to write what I wanted. Others had some constraints. I don't know what the situation is currently in the finance ministry. But as I said, I would caution that you have to read these words carefully. Like, for example, on the fiscal deficit, they said it would be negative for credibility. It's just giving you one of the arguments, right? That's just an argument, which we all know, but we are looking for a signal there. Yes, it gives you a little positive there. So, as I mentioned, what I would read the economic survey for is to see where the focus on the issues is. So clearly, some of those issues will feature in the budget, some will not. The guessing game will
Dr.
continue.
Virmani, I'm sorry, I'll have to cut you short there because I want to get in a last word from Maithili here. And like Dr. Virmani is pointing out, Maithili, finance ministers may give the leeway to the chief economic advisors to put what they want to, or may they do it in unison. I have some idea of how they're working together. Jayant Sinha, Arvind Subramanian and Arun Jaitley are actually locked in a room all the time around. Do you believe this is a sign of things to come on Monday?
Well, I don't know. I wouldn't quite call it a flight of fancy of the chief economic advisor, but clearly, as the former Prime Minister Manmohan Singh said, politics is the art of the possible. Chief economic advisors are not constrained by the possible or the impossible. So I think even if Arvind Subramanian has been telling Jayant Sinha as well as Mr. Jaitley a lot of things, it could be in through one ear, out through the other.
All right. Thank you very much, each one of you, for joining us. Swaminathan Iyer, Maithili Bisnurmat, Atsi Sheth, Dr. Virmani, Sonal Verma and Jayesh Mehta. Thank you very much for sparing time and being with us right here on ET Now as we discuss the implications of economic survey and the prospects it raises for Indian economy. Thanks viewers for tuning in.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.